guys, Brian Stevens here over at Mortgage Ops, the National Real Estate Post. So I have a question for you. This is a good one. Was our last housing meltdown caused by those nasty little subprime loans, or was it the less harmful Alt-A loans, what we call non-QM today, a bigger cause? Because those loans went to prime borrowers who were quick to walk away when prices fell. Kind of like investment communities in Arizona and Florida. They're both a mess right now. But here's the thing. Back then, the industry and our elected officials and the media really didn't include a whole bunch of Alt-A loans in their definition of subprime loans. And just like back then, the term broker became interchangeable for anybody who wrote a loan, even though that wasn't the case. Weaponizing words, my friends. Check out this graph. Sometimes non-prime mortgages, which included both subprime and Alt-A, like interest-only loans and pick-a-pay loans, buyers were getting qualified at the teaser rate. And that's what caused the problem, not our subprime loans. Check out this video real quick. I think it's illuminating.
It's been 10 years since the Great Recession, which is commonly blamed on banks extending too many loans to low-income borrowers with high risk of default, now known as the subprime mortgage crisis. But Manuel Adelino, a finance professor at Duke University's Fuqua School of Business, found that narrative doesn't fit the facts. Adelino and his co-authors reviewed nationwide income, home sales and mortgage data from the years before and during the financial crisis. First, they found there wasn't an explosion of credit offered to lower income borrowers. Credit expanded across the board, most drastically in areas where house prices were rising the most. In fact, they found home ownership rates among the poorest 20% fell during the boom because those buyers were being priced out of the market. Nor did they find the crisis was caused by defaults among subprime borrowers. Instead, Adelino found the numerous bank failures and subsequent recession were caused by middle and high-income borrowers, including speculators buying up houses to sell for profit, who began defaulting at unprecedented rates. The researchers found that because lower-income borrowers were buying less expensive houses and in smaller numbers, there simply weren't enough of them to topple banks and cause the economy's subsequent collapse. Unfortunately, however, regulators bought into the subprime narrative and reacted by making it harder for lower-income Americans to get credit, just as house prices were low. As a result, home ownership among that population has collapsed since the crisis. This has not helped anyone get on the property ladder, and the researchers found it has not added any stability to the banking system either.
So, there you have it. The culprit were investors who were largely living upper-middle-class lifestyles who started the dominoes which led to the last meltdown when they walked away from their obligations. Sound familiar? Well, I've got one acronym for you to ponder for a couple of minutes. Airbnb. How are those performing right now? Answer, not so good. And they're everywhere. Now, are the lenders then the problem? Are the borrowers the problem who overhedged? You can make an argument for both of them, but what about our politicians, who always seemingly run on the platform that everybody deserves a house? Do you remember H.R. 3995, the Housing Affordability for American Act of 2002, which included provisions to lending assumptions particularly focused on making mortgage credit more accessible to low and moderate income households? Wow. That one really sounds familiar. While the bill did not drastically overhaul underwriting standards, it aimed to ease access to credit, exactly like today. Don't change the underwriting standards, just increase the credit score. Listen, 20 years when we were writing loans, if you had a 720 credit score, you were in the top 5%. Now everybody's got a 720 credit score. Pay your medical bills? Not so much anymore. Lates on your credit report? They're not going to ding your scores as much as they used to. All we have to do to fix the problem is just artificially raise our scores. In other words, we're following the exact same trajectory we were in 2002, which led up to the first meltdown. And guys, when you look at some of the markets that we're in, a lot of these properties that investors have right now, they're not even hitting the open market, and they're selling significantly below prices you're going to get with a real estate agent, which means, yeah, we have a problem, but I gotta tell you, I think it's bigger than we both think. Now again, this doesn't bother me because more inventory, well, I could do something about that, and so could you. I hope this helps.